All right, so if you're looking for the breakdown on today's market, especially if you're a retail investor, trying to make sense of it all, we've got it for you.
We do.
It is the Market Deep Dive Closing Report. Hot off the press, ready to unpack. It's Wednesday, November 13th, 2024.
Cute day.
And the big question everyone's asking is, will the Fed cut rates in December?
Right.
And today's CPI report might have thrown a little fuel on that fire, so
yeah, definitely.
let's dive in.
Let's get into it.
The CPI, the Consumer Price Index, really was the star of the show today.
It was front and center for sure.
And it's the key measure of inflation, and while it came in pretty much as expected, it definitely did not give the signal that things are cooling down as quickly as some had hoped.
Yeah, it was pretty much in line with expectations,
Right.
but yeah, not a ton of progress on the inflation front.
Okay, so let's get into the actual numbers for those of us who, like to really look under the hood. What were they? And what should retail investors like yourself be taking away from them?
Okay, so headline CPI, which includes everything, rose 0.2% for the month and 2.6% for the year.
Okay.
Core CPI, which strips out the volatile food and energy prices, climbed a little bit higher at 0.3% for the month and 3.3% for the year.
Mhm.
And so these figures are still significantly above the Fed's 2% target, and that has everyone on edge.
So inflation is stickier than we'd like.
Yeah, a little bit stickier than we'd like.
How did the market react to this news, especially in terms of interest rate expectations?
Well, we saw a really kind of mixed reaction in the bond market, which is always a good place to look for clues about what the Fed is thinking.
Right.
Shorter-term Treasury yields, which are really sensitive to rate expectations, they actually dipped today,
Okay.
which suggests that some investors are betting on that rate cut in December.
Interesting.
But here's the catch. Longer-term yields, like the 10-year Treasury, they actually climbed because those persistent inflation worries are still looming large.
So it's almost like the market is sending mixed signals, trying to figure out which direction the Fed will go.
Yeah, you said it creates a lot of uncertainty, which can be challenging for investors to navigate.
Yeah, absolutely.
Now, despite this overall uncertainty, one interesting development was the strong performance of consumer discretionary stocks.
Interesting. So even with inflation concerns, investors are betting on a resilient consumer.
That seems to be the case.
What companies are we talking about specifically?
Think Whirlpool, Amazon, Home Depot.
Okay.
These all saw gains today, even Tesla, which has been on a tear since the election continued its upward climb.
Wow.
It suggests that investors are optimistic about consumer spending, especially as we head into the holiday shopping season.
It does make you wonder if those holiday shopping sprees will further fuel inflation, though.
It's a valid concern for sure.
Speaking of companies making moves, how did earnings season shake out today?
We had a mixed bag of results today. Cava Group exceeded expectations.
Right.
Their earnings report showing strong same-store sales growth revenue was up a whopping 39% year over year.
Wow, 39%. That's incredible.
Yeah, they're clearly doing something right.
What about other big players?
Well, Spotify missed earnings estimates, but they gave a really positive outlook for future subscriber growth.
Okay.
And guess what? Their stock actually went up.
Interesting.
It shows that sometimes the market is more focused on future potential than past performance.
It's a reminder that investor sentiment can be very fickle.
Hmm?
Any other surprises from earnings reports today?
Rivian surged on news of an expanded joint venture with Volkswagen. That's certainly a win for them.
Yeah.
But it wasn't all sunshine and roses. Spirit Airlines plummeted today as rumors of a potential bankruptcy filing started circulating. Not a good sign for them or investors holding their stock.
It sounds like earnings season is keeping investors on their toes, just like the rest of the market.
Absolutely. And speaking of sectors facing some challenges, the semiconductor sector continued its recent slide. The PHLX Semiconductor Index was down for the fourth consecutive day.
So what's dragging down the chip sector specifically?
A few factors are at play here. Rising trade tensions with China are a big concern for chip makers. It creates uncertainty around supply chains and access to key markets, which naturally makes investors hesitant.
Right.
We're also seeing concerns about future demand for semiconductors, as well as some caution ahead of NVIDIA's earnings report, which is expected next week.
NVIDIA is a bellwether for the sector, so their report will definitely be one to watch. It seems like we have a lot to keep an eye on as we move into the rest of the week.
We do. Tomorrow we'll get the Producer Price Index, or PPI, another important inflation gauge. Plus, we'll hear from Disney and Applied Materials on their earnings.
Busy day.
It's important to remember that the Fed is watching all of this very closely. Any surprises in these reports could lead to even more volatility in the market. And of course, retail investors should pay close attention because it could impact their portfolios.
So stay tuned. It looks like Friday will be another important day with the release of retail sales data, which will give us a better sense of how consumers are actually spending their money.
Yeah.
This data is crucial because ultimately the big question is, will the Fed prioritize fighting inflation or supporting economic growth?
That's the million-dollar question, and the answer will have huge implications for the market and for investors of all levels.
Yeah, absolutely.
Yeah, it's a delicate balancing act for sure, and one that has, everyone kind of holding their breath. It's interesting to see how, this week's market action kind of connects to the bigger picture. We had that post-election rally last week.
Right.
Well, it seems to have lost a little steam, partly due to concerns about the new administration's economic policies.
You're talking about those proposed tariffs, right? There's definitely some chatter about how they could impact businesses, especially those with large overseas operations.
Yeah, absolutely. Tariffs introduce uncertainty and can disrupt supply chains.
And I bet that's making some retail investors nervous.
Oh, for sure, but it's not just the tariffs. The strong U.S. dollar is another factor to consider. A strong dollar can make American goods more expensive overseas, potentially impacting company earnings.
So it's like a ripple effect. One economic policy can impact so many different areas of the market. And this isn't just a U.S. phenomenon, right? Global markets were also down today.
You're right. Most European and Asian stock indexes also ended lower. There are global economic factors influencing things too. For instance, Japanese producer prices rose more than expected, which is raising questions about what the Bank of Japan might do with interest rates at its next meeting.
So it's a global puzzle back in the U.S. Even though that CPI report showed inflation being stubbornly high, there were a few bright spots, right?
Yeah, there were. You're right. Some prices actually fell, like apparel, communication, and household furnishings. Plus, it's important to remember that even though inflation is above the Fed's target, it's significantly lower than the runaway inflation we saw earlier this year.
That's a good point. It's all about perspective. But you mentioned the CPI didn't show much progress toward that 2% goal. What does that mean for the average investor? How will this actually impact their wallets?
Well, it likely means that interest rates will stay higher for longer. This impacts everything from mortgage rates to car loans to credit card interest. Higher borrowing costs could affect spending, which in turn could impact the earnings of companies you might be invested in.
So higher costs for consumers could translate to lower returns for investors. It all comes back to that delicate balance between fighting inflation and supporting economic growth. We talked about the Fed watching these reports closely, but what are the specific indicators they're focusing on?
The CPI and PPI are big ones, but they're also keeping a close eye on the labor market, particularly wage growth. If wages continue to rise rapidly, it could fuel further inflation. They're also looking at consumer spending patterns, business investment, and global economic conditions.
It's like they're trying to put together a massive economic jigsaw puzzle, and each data point provides another piece.
That's a great way to put it. Sometimes the picture becomes clearer, other times it gets more complex for investors. It's crucial to stay informed and be ready to adapt.
Speaking of staying informed, we've covered a lot of ground today. What else should investors be paying attention to in the coming days and weeks?
Well, Friday brings us retail sales data, which will provide insights into consumer spending behavior. Plus, we'll get earnings reports from major retailers like Walmart and Target, with holiday shopping season just around the corner. These reports will be closely watched for any signs of strength or weakness in consumer demand.
Retail earnings are always a good indicator of overall economic health.
Exactly. They can give us clues about the direction of the economy and the potential impact on the markets. And of course, this is all information that retail investors can use to make informed decisions about their own portfolios.
Now, you mentioned earlier that Treasury yields can provide early clues about the Fed's thinking. Can you explain that a bit more?
Sure, the bond market is often considered a leading indicator of economic activity and future interest rate moves. When investors expect the Fed to raise rates, they tend to sell bonds, which drives bond prices down and yields up, and vice versa. When they expect rates to fall, they buy bonds, pushing prices up and yields down.
So watching Treasury yields can give us a glimpse into what the market thinks the Fed will do with interest rates.
Exactly. It's not foolproof, but it's another piece of the puzzle.
Speaking of puzzles, let's touch on the semiconductor sector again. We talked about the challenges it's facing, but are there any potential bright spots on the horizon?
Absolutely. The long-term outlook for semiconductors is still positive. Demand for chips is expected to continue growing as more devices become connected and data intensive. We're talking about everything from smartphones and laptops to cars and household appliances.
Right. The world is becoming increasingly digital, and that requires a lot of computing power, which means more demand for semiconductors.
Precisely. Plus, there are exciting innovations happening in the sector, such as artificial intelligence, machine learning, and the metaverse. These advancements could drive significant growth in the years to come.
So while there are short-term headwinds, the long-term potential is still there for investors who are willing to ride out the volatility.
Exactly. It's important to remember that investing is a long game. You can't get caught up in the day-to-day fluctuations.
That brings us back to something you mentioned earlier, diversification. Can you remind our listeners why that's so crucial, especially now?
Diversification is all about spreading your investments across different asset classes to reduce risk by not putting all your eggs in one basket. You can cushion your portfolio against potential losses if one asset class is performing poorly. Others might be doing well. It helps smooth out the ups and downs of the market.
It's about achieving balance and protecting your investments, and it's something that retail investors can easily do.
Absolutely. And if you're not sure where to start, talking to a financial advisor is always a good idea.
Great advice now for the key takeaway from today's deep dive. What's the one message you want listeners to remember as they navigate this uncertain market?
The key is to stay focused on your long-term investment goals and avoid making rash decisions based on short-term market fluctuations.
Easy to say, but sometimes hard to do when the market is volatile.
I understand, but remember, investing is a marathon, not a sprint. By staying disciplined, diversified, and informed, you'll be well-positioned for long-term success.
Well said. And before we wrap up, I'd like to get your perspective on one more thing. We've talked a lot about how a market reacts to economic data, but what about the psychological side of investing?
Yeah, it's so easy to get swept up in the headlines and let fear or greed dictate your investment decisions,
Absolutely.
especially for retail investors who might not have the same level of experience as some of the bigger players navigating these waters. How can they stay grounded when the market is throwing curveball after curveball?
Yeah, you've hit on a really important point. It's easy to get caught up in that emotional roller coaster of the market,
Yeah.
but that's exactly when you need to take a step back and focus on the fundamentals.
So what does that look like in practice?
First and foremost, know your risk tolerance.
Yeah.
How much volatility are you comfortable with? Once you understand that you can create an investment strategy that aligns with your goals and your comfort level.
And don't be afraid to seek advice. A financial advisor can be a really valuable resource, especially for retail investors who are still, learning the ropes.
It's always good to have a second opinion. Someone to bounce ideas off of. Now, we've talked about all the data investors need to be aware of: CPI, PPI earnings reports, bond yields. But it seems like understanding the psychology of the market is just as important.
Oh, absolutely. The market is driven by human behavior, and emotions play a huge role. Fear and greed can lead to irrational decisions. It's why we see things like, panic selling or chasing hot stocks.
So how can retail investors avoid falling into those traps?
Education is key. The more you understand how the market works, the better equipped you'll be to make rational decisions. Read books, listen to podcasts like this one, and don't be afraid to ask questions.
Knowledge is power,
It really is.
especially when it comes to investing.
Absolutely.
And remember, it's a marathon, not a sprint. Stay disciplined, diversified, and focus on the long term.
Couldn't have said it better myself.
Okay, so we've covered a lot of ground today. What's the one key message you want our listeners, especially those retail investors out there, to take away from this deep dive?
The market is constantly changing. There will always be ups and downs.
Yeah.
The key is to not let those fluctuations derail your long-term goals. Stay informed, stay disciplined, and don't be afraid to ask for help when you need it.
That's fantastic advice, and I think it's a great note to end on. Thanks for joining us today and sharing your insights.
It was my pleasure.
And to all of you listening out there, thanks for tuning in to The Deep Dive.